I was going to make is by looking at some of the numbers in the first poll that came through, it shows that there's quite a few people on here that are not doing 203K loans, and this is a great opportunity for them to start learning about the product and take some of the fear out of it, as we said. It's nowhere near as scary as it used to be, as they say, but we appreciate you being with us. And that having been said, I'd like to just introduce the people that will be presenting today who are with us here, actually doing the nuts and bolts of this webinar. The first person is someone that you probably have heard speak before on one of our webinars. Her name is Pam Seifert. Pam has been in the business over 21 years and has really done everything from closing, processing, underwriting, all different types of things. She's had her DE underwriter since 1999, and currently she's the managing director of all training here at Remin Real Estate Mortgage Network. So we appreciate Pam and her expertise to be on this call. Secondly, another name that's been with us here at Remin for a long time, Ann Stataroudis. She's currently the Managing Director of Wholesale Training here at Real Estate Mortgage Network. She's been in the business since 1970 and has lots and lots of experience in both wholesale, retail, all different facets of our business. And the last person who's on the call, but certainly not least, is a new presenter on the actual, or new panelist, I'll call it, on one of our webinars. His name is Mr. Brian Locks. Brian's a great guy that's been with us for a long time here at Remin also. He's currently our wholesale underwriting manager here, and he's had his DE for the past 5 years. And as you'd imagine, his capacity very instrumental in a lot of things that happen over here from an operational and underwriting standpoint. So we welcome both Pam, Ann, and Brian, and with their expertise, let's kick off this call. Pam, it's all yours.
Great. Thank you, Joe. Thank you, Andrew. And welcome everyone to this session of 203K Revisited. Today's agenda, what we're going to cover, we're going to go through the basics of 203Ks. We're going to go through what properties are eligible for this program, some of the benefits, not only to loan officers, but realtors, borrowers, even the sellers of homes that are in distress that need 203K programs, the basic, streamline, and standard program guidelines, a step-by-step guide for you, the loan officer, on how to take a 203K loan from start through finish, determining the max loan amount. We're going to talk a little bit about HUD REOs, and then give you some links for additional information. So first off, let's just talk generally about the 203K. As you may be aware, the 203K program is FHA's rehab program to repair and rehab residential properties. There are two different types of 203K programs. There's the Streamline, which could be called the little K, or just the Streamline, or also a Standard, which was the first 203K program to come out. And that is also known as a full, regular 203K, a consultant, full 203K. You'll hear them here and there by different names. All 203K loans are purchases or rate and terms only. So there's no cash out refinances allowed on this program, and in fact, even after the whole rehab process is over, there's never going to be cash allowed back to the borrower. Any leftover money after the 203K rehab has to be done to pay down principal balance. So no cash out refinances on the 203K program. A lot of people get nervous when they see 203K that there's going to be a lot of additional paperwork and underwriting guidelines. Well, just to let everybody know, there's no change in the regular credit guidelines. So you're going to follow that 4155 as you normally do now. So, for example, if you have identity of interest, you're still going to have to follow your credit guidelines for identity of interest. If you have a 3 to 4 unit family, you're still going to have to make sure the property is self-sufficient and also has the 3 months reserves. So the credit guidelines are exactly the same. But one thing to remember is if you are going to be sending this to your lenders, please make sure that you're always going to follow your lender's credit overlays. 203K loans allow for repairs to be financed into one loan. So what happens is that you have a property that has a sales price. If it's a purchase, you're going to add on all the rehab costs and to determine what your new loan amount is going to be. After the loan closes, Or at time of closing, the sales price is going to be the sales price, so your seller is going to get paid what that negotiated sales price is, and all the rehab work is going to be done after closing. If you're doing this as a refinance and the borrowers already own the property, then we're going to pay off the first mortgage as it normally would be, and then start the rehab costs after closing as well. Your lender is going to hold back the escrow funds for the repairs to make sure all the work is completed as FHA standards. And there may be FHA inspections required, or your lender may require inspections as well. That really depends on the type of 203K loan that you're doing, as well as the amount of the total of repairs that are going to be done. But we'll get into that in just a minute. So let's talk about property eligibility. It has to be a 1 to 4 unit family that's been completed for at least 1 year. And I get a lot of questions regarding that. A lot of times we're getting questions about builders that the property's like 90% done, but it hasn't been completed. Can we finish it up as a 203K loan? And unfortunately, we are not able to do that. You have to have it completed for at least 1 year, and that's HUD guidelines. Demolished homes or homes that could be torn down during the rehab process are eligible as long as some of the existing foundation system remains in place. So if you've ever seen a construction site for an existing home and then you see the home completely demolished, but they leave up like a door frame or the foundation, you're actually eligible to do a 203K and start from scratch over and build it up as long as you're leaving that footprint of the original home. So you could see how powerful this product could be, because you really could start tearing down an entire property and rebuilding it up from the footprints, and a borrower can get almost a brand new home. You can convert single families to multifamilies and vice versa. So if you have a 2-3 family that the borrower now wants to make as a single family, able to do that with your 203K loans. One thing though on all 203Ks, regardless if it's a Streamline or a full consultant standard loan, all health and safety issues must be addressed. So basically, the property still has to meet FHA minimum property standards, but it can be done after closing. They just have to be addressed in the repair costs and the specification of repair list. So when I was preparing for this presentation, I decided to do some research just to see where we are with distressed properties. And I went on the National Association of Realtors website and took a look at their latest confidence index report from April 2012. So you could see this is very current. 28% of all homes that are currently on the market are distressed. And 30 to 35% of all the properties listed in the market are considered distressed. So you could see, 28% are all purchase sales are distressed, and 30 to 35% of the properties listed are considered distressed. So when we first asked that poll that how many people are doing or originating 203K loans, and we only had 41% of the people on this call originating, you could see how powerful this product is and how much more business you could receive from this. And the last bullet on there where it says approximately 58% of distressed sales included some type of financing, comparing that to purchases from non-distressed and combining it with distressed, only 32% of all sales from purchases have some type of financing. But if the property is distressed, it goes all the way up to 58%. So you could see how you can increase your business by offering the 203K loans. 203K loans, you're taking a property that is distressed and borrowers are being able to walk in there and then be able to build the home that they want to live in. So you're able to have one loan, and it makes home ownership more affordable and attractive in this type of market when there's so many properties going into foreclosure, short sales that need some TLC. Some benefits to your borrower, they're getting one single FHA government insured loan. So really, we're not doing a modification. We're not doing permanent perm to construction loan. We are doing one single loan. There's only one closing. It's going to be your standard down payment, 3.5%. On refinances, you're able to do a 97.75%, just the normal standard LTVs. But your borrower can walk into a home that maybe needs new carpeting, needs a new kitchen. Maybe they want to tear down a wall. Maybe they want to make an open floor plan. They're able to customize their home by doing the 203K, by going through you and having a lender offer this product. Your seller is going to be able to offer their home to more potential buyers, and chances are they're going to have a faster sale of the home because the buyers are going to be able to do that, to purchase a home and then be able to do the repairs after and not before. And as anyone knows that has closed on a home before, funds tend to get tight after you purchase a home. You don't have that extra money to go to do your borrower preferences. By doing a 203K loan, you're able to offer that to your borrower to paint the home, repair the roof, offer it to a home that they may not be able to do the repairs if they were just buying it outright without a 203K product. Your realtor, by offering this and offering this to your realtor partners, they're going to be able to offer more listings and be able to sell this faster by just working with you to show what the home actually could be when it rises up to its potential. The realtor is going to be rewarded with more referrals because they're going to be able to offer this product and show the borrowers, don't just walk into a property and you have to take it as is. You could take this structure and make it what you want. As a loan officer, you're going to be able to add value to your current referral partners by offering this to your realtors, do seminars for realtors explaining this product, and get new referral partners by offering this. It's also a great tool to offer past customers, so you can go to your database of homes that you've done refinances before or done purchases before, and then offer this product as a refinance to them. So let's talk a little bit about the different products, the Streamline versus the Standard. Your 203K Streamline is really intended for uncomplicated improvements or repairs. And in the next few slides, what we're going to do is we're going to go over what is included in the Streamline, or what could be included in the Streamline, and really what does not allowed in that product. The Standard is designed for much more complicated projects that we described before, such as making a multifamily into a single or a single to a multi, or tearing the entire home down, leaving the foundation of just leaving the foundation and building it back up. One thing though regarding Streamlines or Standard, no luxury items are allowed to be included. So you can't add a swimming pool or a hot tub, tennis courts, anything regarding that. We've had questions before where we've had property along the water or a lake, and can they add a dock onto a 203K loan or with 203K financing? And you're not able to do that because you're not able to add any luxury items onto a 203K. So going into a little bit more detail about your Streamline. Now, one thing I do want to make clear is the Streamline may be a little confusing when we say the word Streamline. It's not Streamline documentation as we know right now with Streamline's FHA refinances, which can be non-credit qualifying and minimum documentation. Streamline only really has to do with the process, the overall process. You still have to have a lot more documentation on your Streamline loans. The other thing about Streamlines is that you're only allowed up to $35,000 in total rehab costs. Now, that is not the repair cost. That's the total rehabilitation cost. So you're going to add in also your contingency reserve, which we'll talk about in a little bit. That's your kind of your, oh my gosh, what if we knock down this wall and find termites? We need a little extra escrow in there. It's not including your inspection. It's not including any final title work, anything like that. So it's total rehab cost. However, with your Streamlines, there's no minimum. So you can do repairs from $100 up to $35,000. A HUD consultant is not required. So on Streamlines, unlike standard loans, you do not have to hire a HUD consultant to manage the property. The borrowers are going to be working with their contractors directly, receiving bids for the required work. Now, one thing just to let you know, too, is with a HUD consultant, you're able to have someone manage the entire project, where the burden is actually put onto the borrower. So a lot of borrowers would rather have HUD consultants working with them on standard loans just for that management purpose. HUD does not approve any contractors. It's really up to the lender to accept responsibility of approving the contractors. The underwriters, when their loans are submitted, bids have to be specific to the repairs, and typically they have to break out the cost of the material and the labor. Now, at this point, what I want to do is I do want to ask a poll question. So, Andrew, if you can come back on the line and ask that fourth poll question. And Andrew, I can't see it, so if you could read it, that would be great.
Great. So yeah, people are responding right now.
Okay.
Right now we've got about 1/3 of the attendees have responded so far. Right now the number one is no.
Okay. So the question has to do with self-help, whether or not the borrowers can actually do the repairs themselves. And the next slide actually covers this. And the answer is actually yes. We do allow for self-help, meaning the borrowers can do the repairs. However, HUD discourages this completely. And it's kind of the old saying about the plumber always has the leaky faucet. HUD would rather not have any self-help because the chances are the borrowers may not ever get those repairs done, or if they run into trouble, they're not the professionals and they don't know where to turn. Now, if your borrower is a master, let's say a master plumber, then perhaps they could do some of the work themselves regarding the plumbing, but I wouldn't suggest them doing like the roof repair or any other type of repairs other than that. But self-help is discouraged, although allowed, very much discouraged, and that's directly from HUD. Now, I don't know if we have any loan officers on the call from Texas or anyone who's originating in Texas, but due to your cash out restrictions, when you have a subject property located in Texas, the lender can only pay the supplier directly. So if you have someone doing some self-help, so that going back to that plumber doing the plumbing themselves, anywhere in the United States but Texas, we could pay the borrower and reimburse them for their the materials only, not for the actual cost and the labor of that. So if you have a borrower who is a master plumber and going to bring someone on board with them to do it, we can't pay that other person. We can only pay for the materials. Now in Texas, they take it a step further, and that step further is not only can we not pay the borrower directly for the materials, we have to find out who their supplier is and pay them directly. So if our borrowers went to Home Depot or Lowe's, we're going to have to pay Home Depot or Lowe's for that material. All work, regardless if it's a Streamline or standard, has to start within 30 days of closing and being completed within 6 months. And you're only allowed to have up to 2 draws for the contractors. And there is no special FHA inspections required for repairs under $15,000. Now, this is something that you might want to check with your lender, because some lenders do require inspections regardless of the amount of repairs. Now, really what the major thing about a Streamline is that it's kind of like a one-and-done kind of thing. You have your bids from your contractors that have been approved. The loan closes. Some lenders are willing to pay a portion up to 50% directly to your contractor at time of closing. But most of the time what they'll do is after the repairs are done, the contractor will get paid at that time. So there's no multiple draws. It's not like they have to do one part, then another part, and they keep getting draws. It's only a one-and-done kind of thing. The repairs are completed, they get paid. That's the whole meaning behind the Streamline. Here's a eligible list of repairs, and this comes directly from HUD. And you'll notice on the slide that a lot of it has to do repair and replace. So we're really not doing some major construction. You're repairing, replacing roofs, gutters, and door spouts, repairing and replacing, upgrading heating and cooling systems, repairing, replacing carpeting and flooring. And you'll see this slide right here that goes through it all. And you can also find it on the HUD website. For your complete list, you can see your mortgagee letters 0519 and 0550. Also, just to let everybody know, which I do not know if it was mentioned earlier, but this presentation will be sent to all of the attendees. Along with, at the end of the session, we're going to have a Q&A. Any questions we do not get to, we'll put in an Excel format, and we'll send that out as well to all the participants to review. Here's a list of ineligible repairs for Streamline 203Ks. Any type of major rehab. So anytime you're relocating a load-bearing wall, anytime you're doing a room addition, new construction, that's not eligible for your Streamline product. I've seen Streamlines where they're trying to add in like even a sunroom. That's not allowed. Any additions to the home has to be a full standard loan. You can't have any type of repairs that requires detailed drawings, architectural exhibits, anything that you need like an engineer and architect for, you're not going to be doing as a Streamline. And you cannot repair any structural damage with a Streamline loan. Now, a standard loan, that you could do pretty much anything for. So you can include anything that's on your Streamline list, plus anything more complicated, or even you want to do a standard 203K and have a HUD consultant being able to manage the entire project for your borrowers. It's much easier to deal with one HUD consultant. You could do such products as room additions, moving load-bearing walls, remodeling of kitchen or bathrooms, anything that's going to require an architect or engineer. Anything like that, you're going to use as a standard. Also, any project that requires 2 or more draws. So this does have a minimum cost. It's $5,000. However, there's no maximum. And I've seen properties being bought for $100,000, and then they add $200,000 on. After you have all the documentation along with the appraisal, you're going to submit it to your lender. Your underwriter is going to review the repairs based on the consultant report or the contractor's bid to determine that the repairs are acceptable for either the Streamline or the standard loan, and going to issue a conditional commitment based on the after improved value of the home. The loan is going to close. Don't we all wish it was just easy as that? The loan's going to close, and then the work is going to begin within 30 days of closing and must be completed within 6 months. After the work is completed, or every time that you have work completed, we have to do a few things. First off, your final inspections on Streamlines. Remember, if it's under $15,000, you may not need an inspection. Check with your lender on that. But you're going to also want to do a title update every time that you do some type of inspection to make sure that the contractor didn't place some type of mechanics liens on the property. The borrower has to sign a letter saying the repairs are completed, and then your lender is going to release the funds to the borrower and the contractor. However, they're going to hold back about 10% on each draw. And that's just to make sure at the end of the day there's enough money left over to complete the entire project. If there's anything left over, what's going to happen is that the borrower has to pay down the principal balance. As we said from the very first slide, cash back to the borrower is not allowed, and there's no change in terms either. Once the loan closes, the loan closes. We can't change loan amounts after the loan closes based on leftover funds. And those questions, believe it or not, do come up. So I want to make sure everybody is clear on that when you're speaking to your borrowers about this program. No cash back at closing, no cash back to the borrower after all of the repairs are completed. So how are we determining the max loan amount? Your max loan amount, you're always going to take a look at HUD county limits. That's first and foremost. You always have to be under the county limits. But on purchase and refinances, they're pretty much standard. Your LTVs are 96.5 on purchases and 97.75 on refinances. Now, you may have heard of a form called the 203K Max Mortgage Worksheet, and it could be very confusing to people. But if you really take a look at it, what it is a step-by-step guide showing you what your max loan amount is. And if you read it carefully, it will tell you what figures and calculations need to be put into each box to determine what the max loan amount is. On purchases, always, your borrowers have to meet that 3.5% minimum cash investment. But the calculation is your purchase price or as-is value, which should be one and the same, plus your rehabilitation cost. Now, once again, it's your rehabilitation cost. It's not just your repair cost. It's the entire rehab cost. And on the next slide, we're going to break down what that is. You're going to compare that to your after improved value and times that by 110% to see whichever is lesser. So now you can see also another reason why you want to know what your appraiser put as your after improved value. So you're going to compare those two figures. Whichever is lesser, multiply that by 96.5%, and you have your total base loan amount. Remember, then you have to add in your upfront mortgage insurance premium. But it's as simple as that, just really whichever is the lesser, purchase price plus your rehab cost. Look at that compared to 110% of your after improved value, times the lesser by 96.5%, and you have your base loan amount. Like I said before, all this is broken down for you on your max mortgage worksheet. Here's an example of that. You have a sales price of $200,000 and your total rehab costs are $15,000. That would make your the first calculation $215,000. If we have our appraisal and that appraisal has the value as $220,000, you can see that the 110% of the after improved value is $242,000. Since $215,000 is less than $242,000, we're going to times that by 96.5%. And we have a total base loan amount of $207,475. Then that's the base loan amount, so you need to add your upfront mortgage insurance premium to get your total loan amount. Now, I keep talking about rehab costs, rehabilitation costs. What exactly does that break up to? And if you are familiar with the Max Mortgage Worksheet, that's Section B. Your labor and materials, so everything that we have from our consultants, what we have from our contractors, the repairs from the labor and the material are going to be added together. You're going to take a contingency reserve, and like we said before, that's kind of like what if we knock down the wall and find mold? What if we walk down the wall and find termites? We're always going to have some type of contingency reserve based on the repair cost. It's going to be between 10 and 20% on a standard. The consultant, though, will let you know what that's going to be. And it's not always required on Streamline. However, your lender may require it. It's pretty conservative to have it on a Streamline. However, it's in the best interest of the borrowers. It's in the best interest of the contractors to have a contingency reserve, and most lenders do require it. The reason being is that if something does happen and the borrowers run out of funds and can't pay for those repairs and do not have a contingency, what's going to happen to the loan? We need to make sure that we're making sure everybody's covered and protected, including your borrower. Included in your rehab costs are your inspection title fee updates. Remember, every single time on a consultant loan, you're going to have an inspection and title update. If you have a Streamline over $15,000 repairs, you're going to need that as well. For on a standard full consultant loan, you can finance up to 6 mortgage payments. You can also include any architectural and engineering fees. You can add your consultant fees, any permit fees, and then we have something called the supplemental origination fee. That supplemental origination fee is paid to the lender, and that's for all of the post-closing work that has to be done on properties. And it's going to be the greater of 1.5% of everything added together from above, from labor and materials, all the way down to permit fees, or $350. And remember, that's the greater of those. And then you're also, on refinances, you're able to add a discount points on the repair costs and fees. Now, like I said before, with your Max Mortgage worksheet, there's a section called B, and in that B section, it breaks down all of this. On refinances, you're going to have the lesser of your existing debt plus your total rehab costs. You can also add in your closing costs and prepaids. However, if your borrower owned the property less than 1 year, it's the same thing you would do as a rate and term. You have to use the lesser of any existing debt or sales price. You're going to compare that to the as-is value plus your rehab costs, times that by 97.5%, or you're going to take a look at your after-improved value, and you're going to times that by 110% of that, and then times that figure by 97.75%. Whichever is the lesser, then that's going to be your total base loan amount. Then you're able to add in your upfront mortgage insurance premium. Before I go to that next slide, Andrew, we have our final poll question.
Okay, I'm going to launch the poll right now.
Yep.
Oh, okay. Great. Everyone, if you could just please respond, I'd appreciate it. We got people responding. Almost everyone is saying yes.
Okay, well, that's great. Then we have a very smart audience here. Your HUD REOs, we are allowed. You are allowed HUD REOs and 203K loans. And anyone who's done HUD REOs before, you know how you have that one paid sales contract? Well, if you look at number 4 on there, it's a box and it says what type of financing it is. Well, it's going to state in one of those boxes whether or not it's a 203K loan. Now, we talked about the contingency, whether or not it has to be between 10 and 20%. If you have a HUD REO, it's required to have 15%. Another time that it always has to have 15%, and this is regardless if it's a HUD REO or not, even though it's on the HUD REO slide, any property where utilities are not turned on, you have to have a 15% contingency. Your as-is value appraisal is not required if you have the original HUD property disposition appraisal. So you know how you normally get the appraisal that was completed by HUD previously? You're going to use that as your as-is value. And the only time you're going to need a new appraisal to determine the after-improved value is if the as-is value is less than 12 months older, older than 12 months, and the sales price plus the rehab cost exceeds 110% of the as-repaired value. So a lot of times you do not need to have a new after-improved value, but it must meet those criteria. So we gave a lot of information here in the last 40 minutes. There's additional places that you are able to get information. The number one place I always go for research is www.hud.gov. You can actually put 203K into the search feature, and it'll come up with all of the links to the 203K program. There's also a link to all the mortgagee letters regarding 203Ks, and those are really good always to get some information from, and always good to reference. FHA has an email. It's answers@hud.gov. They also answer all of your FHA questions, including your 203K loans. Another great place that you can get some answers is you can contact your lender. We have a website. We have some 203K information on Remin's website at www.reminwholesale.com. There's a whole tab for 203K where you can get additional information. Or you can email the help desk, underwriting@remin.com, or email remintraining@remin.com, and we would be happy to help you as well. So thank you for your time today. What we're going to do now with our remaining time is we do have additional questions that came through prior to the call. as well as during this call. And just to remind everyone, we will be answering all of our questions, all of your questions. If your question is not answered now in the next few minutes, be on the lookout for an email. We're going to send out this PowerPoint presentation with all the questions and answers so that you're able to have a good reference. So I have with me Ann Stadarudis and Brian Locke, who's going to answer some of the questions. And I'm going to ask Ann, and she'll be able to give me some of the answers. And the first question we got is mold ramification allowed on a 203K? I'm sorry, remediation allowed on a 203K?
Yes, you can do mold remediation. Here at Remin we don't, but HUD does allow it, so you'd have to have that in the work write-up.
Okay. Also, what is your time frame typically to get a 203K closed?
I don't know about other lenders, but typically here it's like 45 days. I'm supposed it could go to 60 days, but usually 45 to 60 days.
You also have to remember on your 203K loans, as long as you're getting all of your disclosures up front, getting your HUD consultant and your general contractor working together, it shouldn't really be much longer than a regular 203B loan.
Why is it when I ask someone about this product, they say to me it takes so long, and there shouldn't be any reason for them to say that it's taking so long. A 203K shouldn't really take much longer than a regular 203B because you would have the consultant's report, everything done by the time like you would get the loan. So for us, it's just a matter of looking at the documents.
So is there any, do you have a list of lenders, or is there a list of lenders that do full 203K loans?
I don't know what other lenders are doing. I'm just thinking that we do it, so I'm sure that there's other lenders out there, but we're the ones that you should really be using.
Can you offer a 203K on an investment property?
No. Remember that FHA loans are only for owner-occupied properties. So even on the 203K, you cannot do an investment property.
What's the best way to market this product?
I would say that if you're working with realtors, you would be giving them flyers so that they would know that if they have a house that's a fixer-upper, that they can present it to the buyers as here's a 203K. When you have refinance people, then you could just be marketing to the your regular what's the word I'm looking for? Your regular
list of people that your borrowers that you work with in the past. Another place to market this product is if you find a HUD consultant in your area, you can kind of work with them directly with your realtors. They could do a specification repair report or even just kind of give some guidelines on a property that may be distressed that's sitting there. And that way, if you have a HUD consultant come into the property, even before a borrower comes into the property, and they do a work write-up, anyone coming to see the property can see that work write-up and see the potential in that home. So don't forget your HUD consultants and partnering up with them even prior to buyers coming in and working as a lender, HUD consultant, realtor partnership together to market this. Are there any limitations removing walls on a 4-unit property?
Actually, no. As you addressed previously, you can actually take a multi and turn it into a single, or you could take a single and turn it into a multi. You would just have to get the proper code from the town, and then you could do whatever it was that you wanted to do.
Now we've all heard horror stories after the loan closes. How does any kind of problems resolve between if a contractor and a borrower, if it arises?
Well, here at Remin, I don't know what other lenders are doing, but we have a concierge, a 203K concierge, who calls the borrower and the contractor prior to closing and then stays in contact with them during the process so that if there's any problems between them, he can address it with them and try to resolve it and be a mediator.
Can a loan be given on a property with fire damage?
Yes, you would just have to get the consultant to write up what all the repairs would be, and as long as the repairs did not exceed what the max loan limit is for the area, you could do that type of loan.
Another question came in about discussing the requirements for pre-1978 paint.
Yeah, and 20% rule. The 20% rule, I wasn't sure exactly what they meant, but let's discuss the pre-1978. If it's pre-1978, any peeling or chipping paint has to be addressed in the work write-up, and it has to be corrected prior to after closing. If they're the only thing I can think of on the 20% is if they're purchasing a house that is less than 90 days since the last transfer, HUD requires a 20% increase that you get a work write-up done from a home inspection, from a home inspector rather. If you get the home inspection done and there's repairs required on there that address health or safety issues, those have to be included in the work write-up.
Is there an upfront mortgage insurance premium required?
Yes, 203K has an upfront, and it has monthly now also.
And those are the same factors as you would use for your 203B loans. There's no add-ons because it is a 203K loan. Can any licensed contractor be used for the cost estimate?
Yes, as long as they're licensed, they're eligible to do the repairs and they're eligible to do the estimate. On a Streamline, we will accept up to 3, I believe, contractor estimates. On a full consultant, then the consultant handles that, and it would be whatever he says.
If your state does not require licenses, then you just need to check with your lender how they handle it. I know at Remmen, obviously, if the state does not require it, we cannot obviously require a licensed contractor.
Right.
What is the max loan amount allowed?
It's the FHA county limit. You can't exceed that.
And a question came in if Remmen offers the full 203K.
And Remmen does offer the full 203K. Right now we're not offering the Streamlines only because there were a few concerns about how the repairs were getting done, but we are offering the 203K full.
What is the proper disclosure on the GFE, and where do you put the contingency reserve?
Yes.
Okay, so that's actually a really good question, and we do get that a lot. So just to make sure everybody is clear, on your GFEs, only certain fees of the 203K have to be disclosed to the borrower. You're always going to disclose on a standard and Streamline your supplemental origination fee in block number 801. Line 801 on the HUD-1 settlement statement, block number 1 is your supplemental origination fee. Your title updates are going to be in block number 4 of the 1100 series, and your final inspections are going to be in block number 3, just as you would put the appraisal. Any permit fees that they want to include into the loan amount as well can be put in block number 6. The only other real fees that belong on the GFE are the consulting fees and architectural and engineering fees, which would only be offered on a standard loan, and those are going to be in block number 6, and that's your 1300 series, the same place as you would put your permit fees. Any other fees, such as your contingency, are not put onto the GFA. Can you refi from a conventional to a 203K?
Yes, you can. You can refi from a VA, from no loan at all to FHA.
And does the borrower have to own the property for 1 year on a refinance?
Well, that one's a tough question because the 203K allows for the appraiser to set what the actual repaired will be. You can go 110% above the repaired value, but you are limited to the original sales price.
Remember that slide when we looked at refinances. If the property is owned less than 1 year, it's the same requirements as your regular rate and term B loans, where if it's owned less than 1 year, you are limited to what the sales price is. So your LTVs and your max calculations are going to be based on that. Can a 203K loan be used to complete repairs when they run out of funds, maybe a builder or the borrower themselves?
Yes. You can, no, I'm sorry, you can't do that.
Well, remember, if it's a home that's not been built.
Well, no, I'm sorry. That question was like.
Well, you know, we're going to answer it both ways. If a home is not completed, so it hasn't been built, it has not been completed for a year, you cannot use 203K loans. Now, if a borrower already owns the home and it's existing for a year, then the borrower can use 203K funds to finish up any repairs that have been started.
Right.
And at this point, it is 2:55 I have. Andrew, do you, we have a lot of other questions, but what we'd like to do at this point is we'll take the questions that have been asked and we'll get those answers out to everyone as soon as possible.
Wonderful. Thank you. Thank you so much. Really, really appreciate this. Yeah, and I just can't believe just a ton of questions. You know, I hate to say it, but we might have to do another one of these.
Well, we're available.
That's good. That's good. So wonderful. And if anyone is looking for copies of the presentation, we will definitely get them out to you within a short amount of time. Everyone, thank you so much for joining us. Raymond, thank you for the support. Thank you for supporting this great product. And thank you for supporting National Mortgage Professional Magazine. Have a great day, everyone.
Everyone, bye-bye.
Bye.
That one was misleading, and I didn't, because I had said that you can't. That's why.